Hey there, potential investors, and welcome back to the Dividend Uncle channel. Today, we're going to unravel the current state of the Singapore housing rental market, and it's all about making informed investment decisions. Let's address the burning question: what's happening in the Singapore rental market, and how might it impact your investment decisions? Let's start with prices. Urban Redevelopment Authority or URA Q3 flash estimate data showed a 0.5% quarter-on-quarter rise in overall private home prices in the third quarter. The performance across different sectors are more mixed. I won't go into too much detail since the discussion in today's video is on housing rentals. But the key takeaway is that Singapore's property prices are holding steady, as discussed in my previous video on navigating the Singapore property market. To buy now or wait? I'll drop the link at the top right corner. Developers are cautious about lowering prices, given the high costs involved, which is a solid sign for potential property buyers. Now, let's shift our focus to the rental market, as indicated by insights from multiple sources. Several recent data and research articles suggest a slowdown in the rental market. After nearly 3 years of relentless growth, the private residential rental market might be hitting the brakes. Rental growth slowed for a third consecutive quarter in Q2 2023. According to the Urban Redevelopment Authority, the rental index for private residential properties climbed at a slower pace, just 2.8% in Q2 2023, compared to the previous quarters. Demand has shrunk as well, with rental volume falling consistently for 3 quarters straight. Interestingly, this slowdown isn't confined to one market segment, it's widespread. Luxury rentals, typically considered robust, have also experienced a dip in growth. Smaller units within the prime segment have been hit hardest, while larger homes have managed to maintain their gains. Implications for potential investors: market stability versus rental pressure. So, what does all this mean for investors? The rental market now faces a triple whammy: increased housing supply, declining local demand, and a slowing economy. With more housing supply coming in, we estimate rents may grow at a slower rate this year. Adding to the mix, interest rates have been on the rise and are expected to stay high for some time. This impacts the affordability of property purchases and may influence potential tenants' decisions. While the market price stability means limited risk of capital losses going forward, potentially lower rentals means lower returns. Coupled with rising interest rates, will this break investors' will? As potential buyers, you will need to balance these factors. So, where does this leave us? No one knows, of course, exactly what will happen to interest rates and the property market. As long-term investors, we can take solace in that Singapore will remain a cauldron of stability, which ultimately is what drives real demand for housing. Before making a decision, here's a word of caution. Given that property investment is an extremely lumpy investment, before you dive into the property market, ensure that your financials are in order. You'll want to assess your investment horizon, risk tolerance, and financial goals. Rising interest rates and a potentially slower rental market mean that you should be more cautious than ever. Assess your financial readiness and ensure you have a safety net in place. In conclusion, the Singapore property market remains relatively stable, making it an attractive prospect for potential buyers. However, the rental market slowdown and rising interest rates present new challenges for investors, particularly landlords. As you navigate these market conditions, remember that diversification and creative strategies tailored to your property can be your greatest assets. Stay informed, stay wise, and make decisions that align with your financial goals. And that's a wrap for today's video. If you found this information valuable, don't forget to like and subscribe. Your journey to becoming a savvy investor continues with the Dividend Uncle. Thanks for tuning in.